If you put your entire Roth IRA in that one stock, you'd be down 35% in a day, and it's down, I think, like 60+% over the last year. Like, that is really, really painful. On the flip side, if you diversify your portfolio into, say, something like an S&P 500 index fund that's going to give you exposure to all 500 stocks in that fund, yes, you're going to be impacted potentially by Netflix, but on a much smaller basis.
I received a question from Steph on Instagram, and here it is. How much growth should one expect in a Roth? I started mine last year, and it's worth about $20 more than I put in. Is this normal? Steph, thank you very much for reaching out to me on Instagram. You can do that as well, everybody, at Marriage, Kids, and Money on Instagram. Steph, I feel your frustration. That is, you hear crazy people like me go on and on about how great a Roth IRA is, and then you go and you get yourself one, and then a year later, you got like $20. So I get it. What gives, right? Well, I thought I'd answer this one with my friend Meghan Rabuse again today. Meghan, also known as the Family Finance Mom, is the host of the popular Finance Explained podcast. As a former financial analyst and a mom of three, Meghan's expertise is spot on for a question like this, Steph. Welcome back to the show, Meghan.
Thanks so much for having me, Andy.
Absolutely. Well, let's help Steph here with her question. Why do you think Steph's Roth IRA hasn't grown much over the last year?
Sure. So it's a great question. And I think a lot of times, especially with people who are new to the markets and new to investing, you hear kind of the headline numbers and estimates that we always talk about. I always tell people, on average, over the long term, the market has grown, depending on the time period, you look at 9 to 10% a year. And that is true over a very long time horizon, like going back, 70, 80, 90 years, you get kind of that consistent long run average return. But there are kind of three key words that you kind of heard me use there over and over again: long run and average. So if you just started last year, I hate to break it to you, but you kind of started at a point in time where there was a lot of inflationary pressure in the market. The Fed had kept interest rates really low to help people out during the pandemic. There was a lot of cash, extra cash kind of slushing around out there. And so a lot of people were putting it into the market, which put a lot of wind in the sails of the market. And so now we're seeing a little bit of what, and technically, officially, the market is in correction territory, and in some instances, bear market territory as well. Now, it is not a reason to panic. And this is, one of the mistakes I see investors make a lot is you want these quick, short-term wins. And when you don't see it, you yank your money out. And what ends up happening is you just guarantee and lock in those losses. You have to, in order to kind of realize those long-term average 9 to 10% annual returns, you got to keep your money in for the long term. And remember that those long-term averages, it includes these ups and downs along the way. So what I try to remind people is when we have these market corrections, when we have these periods where people are getting scared, people are getting nervous, lots of other people are running for the exits, instead of thinking like things are going to get really bad and you should take your money out and lock in those losses, look at it the same way you would look at like, oh my gosh, my favorite brand just went on sale. They sent me an email and they said, 25% off or 50% off. That is the way you should kind of look at what is happening right now and stick with it.
Yeah. Sticking with it. It's funny because you and I do these conversations and it's not as popular to talk about investing when things are down. It's very popular to talk about investing when things are up and we're investing in new things. But it's funny because that's actually, I'm not going to say it's the opposite of the time that you should be investing. You should be investing all of the time. But it's funny to me that this isn't the time when people want to talk about investing. Do you find that funny?
It's people don't like to be wrong, and people don't like to tell people like, there is a chance that if you invest today, like the money you invest today, that it could continue to go down. But one thing that I'll highlight, actually some news that just came out today, the government announced that Q1 GDP was actually down on a real basis. And so that is potentially, it takes a while for the world to announce that we're officially in a recession. Technically, a recession usually means 2 quarters of down economic performance. The stock market is a leading indicator of the economy. So typically, what happens is investors are predicting where the economy is going. The market sells off ahead of when that actual economic activity starts to fall off. And oh, by the way, because it's a leading indicator, it also recovers sooner than the economy recovers. So, something to kind of consider right now is everybody's been saying, are we headed for a recession? Is that why the market's selling off? Likely. But the reality is that is a natural part of the economic cycle. And the other natural part of the economic cycle is recovery. And so, don't try to time the market. Look at it as being on sale, buy in on the way down, and then you get the benefit of those recoveries.
Yeah, yeah, I hear you, Megan. And also, sometimes when people open these accounts, whether they're a Roth IRA or another brokerage, uh, sometimes the lack of growth has to do with what you're invested in or what you're not invested in. Can you talk about that a little bit?
Sure, sure. So, I think we've all kind of heard the saying, don't put all your eggs in one basket. So, when you are investing, you don't want to put everything you own, for example, in like a big tech stock, like say Netflix. Netflix reported disappointing earnings for Q1, and their stock dropped like 35% in a single day. If you put your entire Roth IRA in that one stock, you'd be down 35% in a day, and it's down, I think, like 60+% over the last year. Like that is really, really painful. On the flip side, if you diversify your portfolio into say something like an S&P 500 index fund that's going to give you exposure to all 500 stocks in that fund, yes, you're going to be impacted potentially by Netflix, but on a much smaller basis. And so if you look at the S&P 500 year to date, it's still down, but it's only down about 10%. That usually is a lot easier to stomach than a drop of 35% in a single day or a drop of 60% in a single year. And if you want to go another step further for diversification, you can also balance between different asset classes. So instead of just having stocks, you could also hold bonds, you could also hold commodities, you could also hold investments in different geographies other than just the US. And that diversification gives you exposure to different risk profiles and different economies that are behaving differently at different points in time. And it sort of smooths those ups and downs along the way. And so, I definitely recommend as you kind of further your financial literacy, branching out more, further diversifying your portfolio. And over the long run, it's going to give you better risk adjusted returns. So you won't have as many ups and downs, but you'll still have that long run upward trajectory.
It makes a lot of sense. Yeah, we talk about diversifying your income in life and creating some balance there. This is the same way you could do that with your long-term investments. That way, all your eggs aren't in one basket. The saying you've heard a million times over in your life, but you know it's true because you keep hearing it over and over again. Megan, from I guess an economic standpoint, what do you think that needs to happen in our country? I guess globally for this market to start seeing some upward trajectory.
Yeah, I mean, so kind of what's going on if we take a step back, like big picture, over the 2 years of the pandemic, both the Fed, in terms of monetary policy, so they're the central bank of the US, they control kind of interest rates. And then they did something else during the last 2 years. They didn't just drop interest rates to really low to make it cheaper and easier for people to borrow money. They then also basically created more money. So they flooded the US economy with trillions of dollars, and they did that by basically becoming a really big and active participant in the bond market and in the mortgage backed security market that made mortgages have much lower interest rates and made bonds and kind of other things more broadly have lower interest rates than they otherwise would be. So that was happening. The other thing that happened is the US government, Congress, issued trillions of dollars worth of stimulus package. And so when you add a whole lot of money into the economy, it gives people a lot more dollars. And then at the same time, we had supply chain issues that made there be less goods out there. So when you have lots more dollars chasing not enough goods, we end up with what we have now, which is inflation. So now you see the Fed trying to rein that in. So, how does the Fed rein that in? They raise interest rates. That's why you're seeing mortgage rates now are at their highest point since like 2009. So, where like a year and a half ago, you could buy a house at like a 3% rate for 30 years, today, if you took out a mortgage, you're going to pay north of 5%. Now, that's still low by historical standards, but it's a lot higher than it was a year and a half ago. And that's happening kind of all across the economy. It makes it harder to borrow money. So that tries to kind of rein in those too many dollars chasing too few goods. The other thing that is happening that's hopefully going to help is obviously a lot of the stimulus benefits that were around the pandemic, those aren't there anymore. So that is hopefully encouraging more and more people to go back to work. Because one of another kind of source of inflationary pressure is that wages are rising, which can be a good thing. But if wages are rising because there just aren't enough people working and there's no improvement in productivity, that actually adds to some of the inflationary pressures that we're seeing. So, in some cases, like a little bit of a slowdown could be helpful to take some of the wind out of the inflationary pressures that we're seeing. Really high inflation just makes for an unstable economy, right? Like it doesn't make you feel good when you go to the grocery store and it costs you 10% more than it did a year ago. It gives you a lot less confidence about your own budget, your own spending. Maybe you're not going to take a vacation this summer because it's costing you more to feed your family every month, to fill up your car every month. And so all of those things are kind of having an impact. So I think if, as much as higher interest rates hurt, and as much as that's some of why we're seeing the market sell off, if it helps us get inflation under control, that will provide a stabler, better long run economy. So think of it kind of as like some short term pain for hopefully long term gain.
Got it. Got it. Well, so Megan, there's somebody listening right now and they're saying, you know what, this seems like a big old mess. Stocks are down, inflation. This is just, I'm just going to wait until things get a little bit better in the market. Then I'll jump in. What would you say to that person?
I said, don't try to time the market. Retail investors, and when I say retail investors, I mean people like you and me, people out there listening, people who are not professional money managers. And oh, by the way, they're not real good at it either. But retail investors are notoriously horrible at timing the market. And the evidence we have of that is that they underperform the overall market as a whole significantly. And when I said, oh, by the way, professional money managers are too, like 75% of professional money managers don't beat the market over the long run either. So, both of those things, what they tell me is be consistent, keep your money in the market, and buy index funds. Don't pay high management fees to somebody to manage your money who isn't going to even beat kind of what an index fund will do for you anyway. And the reason that it's really hard to time the market is that it requires you to be right twice. It means you've got to sell when the market is at its peak, which typically doesn't happen. Usually people are fleeing for the exits as it's already on its way down. And then you also have to buy right, which means buying when it's right at the bottom, which also doesn't usually happen. Usually people are buying back in as it's already soaring on its way back up. And if you look at kind of like the day to day performance of the market, oftentimes like the performance is driven by just a handful of days. And so if you miss and aren't in the market for those days that are really up, you miss out on kind of that long run average performance.
Yeah, I think that's a good point. And this percentage that you and I share on the show you just shared earlier of like, hey, a 10% average over the 70, 80, a long time. I think the real average, and correct me if I'm wrong, for people who are, I guess, owning their own, portfolio and then sort of buying and selling when they think they feel right, is probably closer to like 2% or even less because they are allowing those emotions to get the best of them and they're missing those big days where the market goes up. I don't know if you've heard that statistic. Yeah.
Yeah, I mean, I don't know exactly kind of what I haven't looked at that recently to know exactly where retail investors shake out. But in addition to like underperforming the market average, you're also adding costs to your portfolio. You're adding transaction costs, you're adding trading costs. And you're also potentially, if you're not in a tax advantaged account, like incurring, creating taxable events. So all of that is negatively impacting your performance.
Yeah. So, in short, keep contributing, stay there, be consistent, diversify. Steph, this is the way to go. So, if you haven't seen a lot of growth at all, that I'm surprised that you even saw $20 of growth over the last year, because it's been a down market over the last year, and hopefully we'll see some better days. But if this is a Roth, like you said in your questions, a Roth IRA, there's a purpose for that. You are investing for your long term retirement needs. So give those decades a chance and keep with it. Megan, this has been a fantastic conversation as always. So what's going on with you in the family finance mom world?
Sure. So, for those who want to learn more, in particular about investing, I actually have an investing workshop series going on right now. It's a monthly live workshop. If you can't join live, you get access to the replays. And it's 6 months long. So, we started in January. If you register now, you will get instant access to the first 4 months that are already out. And then you'll be able to catch the next 2 months as well. But we cover things like retirement accounts and understanding the ins and outs of those. We talked about the stock market and some of the history and data points that I've shared here today. We talk about understanding risk. So, what does risk actually mean? How is it measured? How is it calculated? How do different asset classes have different risk profiles? We talk about things like what is a stock, what is a bond, how they work mechanically speaking, and then also how they impact and benefit your portfolio. And then the next two that are coming up are on diversification, which we just alluded to. And then the last one is investing formulas. So understanding the math behind finance. And like things like the time value of money, which is really, I think if you can understand that, you can understand just about anything in finance because that's kind of the fundamental building block. So if you go to familyfinancemom.com, there's a registration link right at the top. You can check that out. In terms of Finance Explained, I'm super excited this week. Actually, it's coming out later today. I have a podcast featuring an ag panel of three agricultural experts. One is an actual farmer. One is like a professor of agricultural strategy. One is an agribusiness CPA, so he consults with farmers and ag producers about how to maximize their business. But we're talking about the impact on the US farming economy today. So, why are people seeing 10% increase in food prices at the grocery store? What is kind of their outlook for going forward? Do people need to be worried that there's going to be a food shortage? Things like that. A lot of the questions that I've been getting from my listeners about, their grocery budget and just concerns about what's going on in Ukraine and the impact on the food supply and things like that. So I'm excited to get that out today.
Absolutely. Well, yeah, everybody, if you're looking for some, I guess, a great way to just understand what is going on out there, Megan has a fantastic podcast, Finance Explained. It's exactly called that because she's explaining this stuff to make it easier for everybody to understand. It's a great show I listen to every week. Megan, thank you so much for your time today. I really appreciate it.
Thanks so much, Andy.